Stocks can't seem to shake those trade war fears that have been around us for a while and haven't kept us from trending higher. But will it provide the spark for a pullback that we've been waiting for now and anticipating here for the last week or so? So I'm going to break that down and what the technicals are showing, how likely we are to get that pullback now compared to last week. I'm also going to talk about some main drivers from a macro perspective on markets right now, the sector rotation from laggards, from leaders to laggards, and vice versa, and where we might be able to take advantage of a bearish trade in a sector that's starting to work its way down the rankings. Let's go ahead and get started. Today is Monday, September 17th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Market Scholars logo right here in the bottom right corner of your video. Then click the subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells me that you got something out of it tonight, that you want us to do the video again tomorrow. Quick, really easy way to give us feedback there. Comment on anything that stands out to you from tonight's video, questions or comments that you might have. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link to subscribe. Very easy way to do that. Follow me on Twitter for more content like this throughout the day, and join our Market Outlook community on MarketScholars.com, as well as our Market Outlook community on Facebook. All right, again, like last Monday, it seems to be a sound issue again for the next few minutes. So I tried to make the sound work out as best as I could. After a few minutes, it'll be back to normal. So keep that in mind. All right, well, let's take a look at the S&P 500 with the market forecast indicator first and foremost. And you see that we have a strong bullish posture still, despite today's decline. The intermediate line made it run a little bit higher up to 81.84. Of course, short-term sentiment fell. The momentum line did not fall to an extreme low point. That'd be the 5th percentile on the downside. And we didn't get that far down. Near-term line came close to dropping below the chart's midpoint. So, of course, there is news, you'll hear me refer to it throughout the video, coming after the bell that Trump will announce new tariffs, potentially, with China. So that can impact a lot of this. But aside from that, just looking at the technicals, again, you would expect a bounce off of this low point for the next day or two at least, considering the bullish intermediate confirmation signal, the oversold momentum line with the strong bullish posture. Now, don't get me wrong. I don't think necessarily that if we do bounce, that we'll go up to highs or to new highs, or even that much significant new higher highs. If we do get above 29.16, I've mentioned before in my previous video, 29.30 appears to be a resistance level for it. We had already hit that 60%. I'll show you again here in a minute. I've already hit that 62% Fibonacci retracement on the extensions of one near-term line to the pullback because of how far the pullback was. So it's not surprising that we're running out of gas at these levels. And today's close below the prior couple of days' low points is significant. So again, just the market forecast, you'd expect a day or two bouncing, which we could very well get. But the close today is a pretty significant bearish close. Again, we've been expecting a bearish intermediate posture, a dark pink shading, which would mean the intermediate line gets below 50. We've been expecting that to occur sooner rather than later, probably sometime within this month, if not this week, maybe in another week or two. But at some point we'll get that, and we'll be looking for where it can eventually fall down to. As you see, there's our low point, there's our intermediate low point, the last intermediate low point. Here's the current, as of right now, the intermediate high. So you'd be looking for a move down. First of all, for support down to this 23% Fibonacci retracement, which also happens to line up with that old January high. But also you see the 38% Fibonacci retracement and the 50, both sitting above this 2800 level. So there's going to be some support areas in here that we can run down to, especially when you look at SPY and the volume profile for that. So Again, that would set us up for a good bullish move heading into the end of the year, which is what we typically get. Whether it'll be that, this is January, but this is the type of bullish move that we got last year, coming out of the end of September. You can see that's the rally we got. So we can get something like that again. More likely if we start off with an intermediate low point like this that we can bounce off of and start a new monthly run. We're already more than 2 months into this run. If we were to go all the way to the end of the year, that's another 5-month run similar to this one. A 5+ month. And that's what came out of that. We don't want to see that again. We want to see nice and orderly highs and lows, and so that means that we should get a low, and that's what we would expect is to get a low into this area. But take a quick look at the Dow Jones Industrial Average, and you can see it's got a strong bullish posture. It's got the same intermediate confirmation signal with this one does have the near-term line below 50. So again, would suggest in the next day or two we can have some bullishness. The NASDAQ, this is a little different story because it's close to giving us a lower near-term low point. We're obviously coming down from a lower near-term high, and we're already approaching the prior low. Now there happens to be some support in this area. There's some old highs here that we can hold for support. So until we break it, but you can see the momentum line. Now granted, this is a more volatile index, so you tend to get more extremes to the highs and lows on the NASDAQ. You can see the intermediate line also turned down pretty quickly. So back to a bearish posture for the NASDAQ. The Russell 2000 has closed below all those lows. So again, a pretty bearish close. It's got a bearish posture again, extreme low on the momentum line, near-term line coming down from what would be a bearish high. So again, you can see how the NASDAQ and the Russell are kind of setting up for this intermediate bearishness. You can see that they're already shaded light pink. Remember, light pink doesn't end an intermediate run. It's the dark pink that ends the run and sets us up for a new one. So we're not there yet, but we're starting to get more intermediate weakness there than we have on the Dow and on the S&P. So they might be a precursor to what we can expect, more of that pullback. Like I said, the Russell's already broken below those lows. The NASDAQ's sitting on those lows. So is that what we should expect to see from the S&P and the Dow as well? All right, a quick reminder that as you're watching our video on MarketScholars.com that we ask for 3 clicks that tell us that you want us to do the video again tomorrow. Really quick and easy. You can do that right now. One is to click on the heart right here on the Market Outlook tweet, and then click on that like button. The other is to click on this Facebook image here that brings up this page where you can click on the like button and let us know there on Facebook. And of course, the third one is here on our blog. You can click on that like button. Remember, you have our class schedule, including tonight's beginning options class from Brandon here, as well as my more intermediate class tomorrow, and Brandon's dividend growth, his DGI class, they have scheduled for tomorrow. Remember, there's also a link here to participate in our forums. You can do that by subscribing by clicking on this image in the top right corner under Join Market Scholars. If you take a look at the weekly chart, you can see that the momentum is still strongly bullish. It is turned down a little bit on the MACD, which means the gap this week, we're only one day into the week, but the gap this week so far has shrunk between the 50 and 200-day moving average compared to last week. Not by much. Remember, there is that divergence, but these bearish divergences can take months to play out. So I'm not looking for any kind of bearishness because of that, simply because of that, anytime soon. These more long-term extended bearishness. You can see despite the pullback today, we're still above a rising 50-day moving average. It's still above the rising 200-day moving average. That gap is not growing so far this week, but it's still very high, and we don't fall off cliffs when the long-term MACD like this is this high. We can get some weakness and we can slow down the long-term bullishness like we did here, but we don't typically have these kind of fall off the cliffs, and we did there because of how abnormal that move was, where we should have kind of more pulled back in this area. Then we wouldn't have had as big of a sell-off, and that would have been a little more orderly. We didn't, and we rallied up significantly into January, and then we got that kind of orderly. So I don't think necessarily we're getting kind of a disorderly grind and move higher right now that would cause us to fall off a cliff from these really strong positive momentum levels. Again, looking at the Hakken-Yashi candles, we've got a new higher close, and as of right now, we got higher open. We also got a higher close so far, and don't have a lower shadow. So again, as bearish as today has been, it's only one day into the week, and the Hakken-Yashi candle is still looking okay for now. Still 4 more days left. You look at the 3 green arrow chart, and you can see we never did get the green arrow on the MACD. If you look at the 3 line version of this, it's pulling back from its moving average. The stochastics did cross above its moving average. We did pull back today and close a smidgen below that low point. So that's it. That's as low as we got. Below, the 8-day moving average. So again, it's kind of hard to be too bearish when we're not even closing, when we're barely closing below the 8-day, and we're not below the 17 days. So there's still, we still got bullishness. It's not as, we're losing momentum. We still got positive momentum. We're losing that momentum though, and the buyers, there's still positive sentiment. We're not as positive. You can see the stochastics is down to 62. Remember, this is a 5-day average. So 62% shows that the closing price of the last 5 days on average is 62% of the 4-week range. 100% of the 4-week range would be the 4-week high, of course. 0% would be the 4-week low. So we're obviously closer to the high than the low when you average out the closing prices for the last 5 days. So again, shows bulls still have the ball, so to speak. But you can see while the MACD did turn down, the stochastics slowed down on the 3 green arrow chart. You can see on the intraday chart when the news came out that the president was going to announce the decision on China trade, most likely tariffs after the market closed. That impacted the close into, we were trying to get back up above Friday's low, and we couldn't. The news came out and pushed us down to the low of the day. So bearish candle from that perspective, a lower high, a lower low, closing below yesterday's low, still up above the Hakken-Yashi open. That's the purple line. So we don't have that lower shadow yet. We'll see what happens. And you can see in the after hours here, you take a look at the after hours, we're up a little bit until that announcement comes out. But we'll keep our eyes on that purple line. Of course, this dotted line is the midpoint of the 4-week range. That's going to change dramatically tomorrow because this will come off and the 4-week low will move up to about right there. And then the day after that, it will move up to there. So this is where, in this area is where the low point's going to be. It's going to move up a couple of points, which will make, without the high going up, it'll make this move up a couple of points. So we'll move up into, kind of this area here, or at least a point. So we'll see what impact that has on the 4-week range and where that dotted line ends up. And then after this week, you can see here's the low point for Friday. Then we're going to move up to right there. So essentially, after this week, the 4-week low will be last week's low, or like right around it. So that will really tighten up the range unless we get a new 4-week high by the end of the week, which as of right now is not looking as likely because of how far away we're pulling down. We're not into the lower half of the chart, so if this were shaded, this would still be shaded green and not pink because you're trading in the upper half. But keep in mind, the halfway mark is going to change. It's going to change tomorrow. It's going to change again by the end of the week. So we'll see where we end up trading according to where that halfway mark ends up getting to. All right, we take a look. I wanted to show you the S&P extensions. So there's the extensions. Again, we got up to the 62% Fibonacci retracement on Friday, and we've pulled back. We've pulled back so far, back below the Fibonacci retracement zone. So there's the Fibonacci retracement zone, 38 to 62. You can see we've kind of gotten back down below it. So another sign that that near-term run is very well could be over. And like I said, the Russell 2000 is already below those lows. Right, these lows from over here, the Russell 2000 closed below last week's low. So that kind of just shows where we might be headed. If you look at the NASDAQ composite, there we go. That's sitting right at those lows that we draw those extensions from. So things are looking like the short-term sentiment picture is looking like we may run into a more intermediate pullback than what we've gotten, which would be okay. Again, we haven't gotten that, and for a few months, it's normal to get one now. We know where to watch for a low point to occur. It will not be the end of the world. A bear market would not be starting, most likely. A recession would not be starting. But we would look for a low point to occur at those support levels we identify, and then for a new intermediate run to start from there. That would be the expectation. Of course, you break those lows, things change. But until then, you expect support to hold until it doesn't. All right, let's take a quick look here at the SPY, and we'll look at the volume and the trading range. Trading range, so again, as bearish as today was, trading range a little bit below average, and the volume was at 65 million, so a little bit above average. So let's put that move in context. The trading range at 1.83, again, a little bit below average, and that average is relatively low, could go lower according to the 52-week range. And then the volume at 65 million right there, a little bit above average, but still very low relative to the 52-week range. And again, the relative ATR still on average way below 1%. So again, above 1% means we're getting almost 3-point moves on SPY. We didn't get that. We didn't even get an average move today. So again, keep in mind, we're not talking about the end of the world here. We're not talking about the market tanking. These are the kind of bearish moves that would be perfect for an intermediate pullback. They're not that bearish. We're not getting these kind of sell-offs. We're just kind of getting a nice orderly move lower that will bring the intermediate line lower and eventually, ideally, turn back up and continue this trend, this long-term market sentiment trend of 6 to 9 months that we expect, which would be the third intermediate rally within that expected run. So all right, to summarize, we're seeing some short-term weakness. We're seeing not only some short-term weakness on the decline, but the fact that we did not get new higher near-term highs as of yet on all the indexes, but especially on the NASDAQ and the Dow, would tell us that we might be headed towards that intermediate low point that we're now expecting. Now there's these intermediate confirmation signals on the Dow and the S&P that could say that tell us to anticipate maybe another day or two of a bounce off of this selling, but not to put a whole lot of stock into it, considering the weakness we're seeing and the more risk appetite, the more higher beta indexes like the Russell and the NASDAQ. What we're seeing there shows that we're starting a new near-term trend to the downside, and multiple near-term lower highs and lower lows. Obviously, that's what gets you to those intermediate pullbacks. So what do you think? Do you agree with that assessment? Do you disagree with that? There's a link popping out as always in the top right corner of your video. Click that link and then click either agree or disagree. If you click on disagree, scroll down to the bottom, either on the blog post on marketscholars.com or on the YouTube channel, and then comment on what you're seeing that either would tell you that you're more bearish than what we're looking for, or that you're actually probably more bullish, that we should not be anticipating this intermediate pullback. So let me know what you're seeing there and share that with our Market Scholars community. All right, now let's take a look at what's going on and what's driving the price action today. Of course, today was when we had a down day for stocks, small cap stocks, growth stocks, mid cap stocks, emerging market stocks, particularly in China, but not down as much as we see in the U.S. As you can see here, the S&P is down right there with it. You can see agricultural, again, a consequence of the trade issues that are going on. But in this case, the dollar didn't go up. The dollar's continuing to go down. You can see that helped propel these developed markets higher, these other foreign markets higher. Real estate continued to be strong. Real assets, gold benefiting from the strength and weakness in the dollar. And you can see value stocks in the S&P holding up along with dividend stocks. More you would say are more interest rate sensitive, TLT started the day down before rallying, which means that the yield started higher and then yields pulled back by the end of the day. Again, we take a look at these foreign markets and how they're doing here, and we'll bring up this list here. You can see Brazil had the best day. Nice, good close. We haven't seen a move like this in a while. And then there's Italy, the emerging market of Europe, so to speak. And of course, Russia continuing its outperformance. Russia and Italy, two of the only foreign markets that are above their moving averages. France is kind of flirting. Japan's up above it. Japan started off with a really strong day before giving back some of its gains. Again, kind of in sympathy with what's going on in Asia and how that can impact. You can see India also dropping. Usually India has been kind of insulated from this Asian weakness, but not today. Pretty broad-based weakness with what's going on in the U.S. Of course, the U.S. still above a rising moving average, which is the only one of these 12 that has that. So keep that in mind. Down today, but continues to show a relative strength compared to its peer. Let's take a quick look at the dollar chart here. We'll take a look at the long-term view first. This is the dollar futures index, the cash index. You can see starting off the week, kind of filling in the long lower shadow from last week. So a bearish candle there you can see on the Hakinyashi. Last week we had a small body with an upper and a lower shadow. This week still no upper shadow. So things look to be, at least appear to be, rolling over on the dollar from this Fibonacci resistance after having that kind of impulse move to lower lows throughout most of 2017 and the early part of 2018. So as the dollar run over, and of course we all know the consequences of that, you should expect to see these developed markets continue to outperform on a more of a long-term basis. You can see again the 3-month returns. You still have Switzerland, Brazil. There's Thailand and Taiwan. Russia's up now, outperforming ACWI. The S&P 500 you can see the S&P. Well, if you look at the S&P 500, it's not showing up on that chart. But if you look at it, here we'll go to this chart here. You can see its 3-month returns at 4.15, so it's going to be right underneath Switzerland there and above Poland. But you can see some of these others, of course, Turkey, China, Argentina, they've all had their issues. And there's Indonesia, so all these emerging markets with their issues. Germany, UK, Italy, Netherlands, Spain, France, they're all down. But with the dollar pulling back, you'd expect that these index, especially these European, if developed market continues to outpace emerging, I would expect to see more emerging market weakness until you see these trade issues resolved. Then China and the rest of Asia will rally higher. You probably see, these currency are hurting Turkey and Argentina. Those are their own individual issues, but the rest of these more Asian oriented emerging market currencies, once those trade issues get resolved, and you expect at some point they will, again, according to past precedent, not because of any political bias, but that seems to be the MO. So if they do, you would expect all of the dollar to pull back and all of these to make their way higher. But until then, until there's any resolution, the weakness in the dollar will help out these European countries, France, UK, Germany, those kind of countries. They'll start moving their way up here to the top of the list. One more chart I wanted to look at is the 10-year yield. You can see getting back up above 3% on the past week. We had started to break back down below that line again, only to go right back up here this past few weeks, you can see so far today, starting off strong today, but then giving some of that back. So very important 3% level. We've hit it multiple times. We've pulled back down from it every time, and we'll see if that ends up being the case here. You've got a strong bullish posture. You've got near-term highs that are getting progressively lower as we move higher. So we're getting some weakness into these areas. And again, any kind of intermediate pullback, you would expect yields to pull back along with it. All right, now let's take a look at how the sectors are performing. You can see our biggest losers, discretionary technology, of course, XLC, which has some of those stocks in those areas, also pulling back. So a lot of these FANG type stocks, that's why you see the weakness in the NASDAQ composite market cap weighted index of Russell 2000, pulling back in sympathy with that, of course. Remember, already breaking below its recent near-term lows. On the other end of the spectrum, the dollar dropping and yields dropping, at least from their open, helped lift utilities and real estate, which are interest rate sensitive staples, also kind of dividend related. And then you have energy and materials also outperforming and gaining today. Again, if the dollar continues to pull back, if yields continue to pull back, expect to see these areas of the market continue to outperform. And you can see here the rankings here. These sectors are sorted in order of Brandon's most recent sector selector rankings, which you can get on our blog at marketscholars.com. You'll see the post here. Of course, premium members, if you click on it, you can get more detail into the individual stocks and data points that drive these rankings. That can give you some ideas. But this is the ranking so far. And look at utilities and real estate. They're right up there towards the top. Healthcare is a strong sector. There's staples, and then of course materials and energy, which have been the worst performers, are starting to gradually progress and move their way towards the top. They're above their moving averages. Everything is above their moving averages, but look at technology and discretionary. Look at the deep declines. And again, I mentioned this on Friday, but we are getting a rotation. These are not your best performing sectors anymore. We're moving towards these other areas, these interest rate sensitive areas, safe haven areas, industrials and healthcare. Those are your pockets of strength right now. When you look at the 3-month chart here, again, healthcare is a top performer, and utilities is up there too. They're staples. The green is the telecom area, and then real estate. They're your pockets of strength, with your technology in red now underperforming the market, and discretionary in orange coming down along with it. Of course, materials and energy are your two worst performers, and that's going to be your opportunity. With weakness in the dollar, that's going to be your opportunity for relative performance going forward. And if yields pull back, expect the strength to continue to persist, especially in that utilities and staples area. All right, that brings us to a pocket of weakness in that discretionary area, and we'll take a look at a stock like McDonald's. McDonald's has been a pretty decent performer, especially in 2017, with that, with the weakness in the dollar. McDonald's really had a good run out of that. But you can see, lately it's been kind of down and really kind of forming a descending triangle in the long-term basis. And today, closing back below, even with a rise off of the intraday low, which occurred right at the open, we're still below the 200-day moving average. And the 50-day moving average, you can see here, or the 10-week moving average, crossing below the 50-day, and you can see that down here with the negative value on the MACD. That's what that represents. So, pretty bearish sign for McDonald's. If you take a look at some other charts, obviously the chart, we closed below that low point. Let me show you what that looks like on this chart, and when it occurred. See, it occurred right at there's that low point from back here a few weeks ago. You see how today we closed down, formed a new 4-week low at 156.5 before rallying back up to that old low point here, and then going slowly down. So a little bit of a dead cat bounce. We'll see if that ends up playing out. That the expectation would be for it to be more bearish. You can see today's move getting down below a volume node, a important volume node around 160. So breaking below 160 was a significant. That's why it took so much to do that. You can see on the 3 green arrow chart, spike in volume, 3 red arrows, spike in volume. So, and of course closing below that low over there. And of course, looking at the DMI today, the negative line crossing above 26 for the first time in a while. This is the last time it did. So, bearish patterns developing for McDonald's in a weakening sector that was a pocket of strength that we expect now not to be, at least as it trends lower. So we can look at doing a bearish trade on this. Whether you want to buy a put or sell a call, a call vertical. Of course, typically we tend to move towards the verticals here. They can be quicker trades. They can get to our targets quicker. So we can sell the 162.5 and buy the 165. $2.50 wide spread going for a 30% return on risk means about a 58-cent credit, which we're obviously getting more of here. If I were to analyze this trade, we'll just take a look at it on a single symbol here. Set our slices to break even. 75% odds of success. We'll set that slice onto the chart. Here we go. Set that slice onto the chart. Let's go just a little bit out here. In fact, let me get rid of some of these lines. And let's go out a little bit further. Let's go out 50. Period. So our earnings as of right now is scheduled for after the October expiration. This is November expiration, so November the 2nd is right here. Excuse me, November the 2nd would be right here. So it's a little bit before that. So, we want to, ideally hit our target before we get to that earnings and pull out of this trade before then. If you take now, let's go back and reset that line on the chart, the break even. So there's your break even. That little breakout, it got up to 165 and couldn't hold that. And then these last 2 days of declines, we'd have to reverse these last 2 days of declines for us to break even to get to that point where we get to this level. Of course, we can go a little bit past that before we take a $76 loss, which is what we're willing to take before we want to pull out of this trade and move on. So we've got some room to work with. Ideally, if it keeps going down, remember there's volume now above us and not as much volume down below us. Even with all those low points, not as much volume, and all the volume has been up in this area. So resistance above us, not as strong as support below us. So if we can get to a decent percentage of that return quickly without having to wait for the other half, then we can hit our target, move on to something else. All right, well, that wraps us up for today. Thank you very much, as always, for tuning in. I appreciate your time. I want to hear from you now. What do you think about this? What do you think about the things we talked about in the video today, the market posture, what's impacting these prices, our trade idea, questions or comments on any of that? Let's post it in the forums, that link that popped out there in the top right corner of your screen. If you have any questions or comments on anything I didn't cover, remember, let's post that in the forum too. And the reason why I would like to direct you to the forums is, there's other market scholars that participate there as well that have been listening to these videos for so long that there can be a good discussion there with me and any of our market scholars. Of course, you can do that on YouTube as well, but you can participate in our forums on marketscholars.com for free by subscribing with the process I showed you before. So again, I appreciate your time tonight. Have a great rest of your evening. Remember to subscribe to our YouTube channel, click the thumbs up icon and comment, follow me on Twitter, and join our community on marketscholars.com as well as our Market Outlook community on Facebook. Have a great rest of your night, and we'll see you all next time.